let's talk about margin and leverage. If you want to buy, would buy one BTC in this area, so this is in October, one BTC would cost almost $13,000, 13K. So to buy one BTC, you needed 13K in the account, pretty much. So in spot exchanges, you don't have the opportunity to use leverage, but in many exchanges, you can trade this as a contract with leverage. So what does that mean? So to buy one BTC here, as I said, pretty much 30K. So one BTC, sorry for the typing, at 13,000, let's do dollar sign. So margin 13K. There. So yeah, need to have quite a lot of money in your account to take this trade. It kind of feels a little bit wasted to look 30K margin for this trade when the stop loss is so close. So what you could do, you could add something called leverage. So you should still only buy the one BTC because you want to risk 1%, and I will show how that is working. So, but let's say you want to do the same one BTC. So at 13K, 10x leverage. What does this mean? It basically means that you're only putting in 10% now of the funds, so basically one divided by the leverage, and that will mean it's not completely accurate. Some margin fees and stuff, maintenance margin, but basically now you will only need can I type correctly? Margin, yeah. So basically with 10x leverage, you will only need $1,300 now and not 13K to do this trade. And the leverage, the leverage will impact the margin requirement. You're basically loaning the rest of this amount. So you're putting in 1,300 and 11.7K, the rest, you're basically loaning from an exchange. There's one other thing with adding leverage. With leverage, we will actually get a liquidation price. So with 10x leverage, you're basically liquidated after 10%-ish of a move. Let's go back to the order tool here. I think it's open still. Yeah. So with this order I showed earlier, with 10x leverage, there is a liquidation price at 11.7K basically, meaning that if this trade isn't working out, all the margin you spent on this trade, so the $1,300 in this example-ish, you would lose that one. That shouldn't be a big problem because remember, you had a stop loss at 12.8. So because you had a stop loss, it doesn't matter that you have a liquidation price of 11.7, so down here. What you actually can do in this example, there, so the maximum leverage is 71. So let's just do the same calculation for, you want to do a little bit below, so let's do 60. Click on buy to recalculate. Now the liquidation price is 12.8-ish, meaning that if you buy here and the price is dipping below basically 12,800, your position will be liquidated. so it will be forced closed by the exchange. But that's still fine, because you have a stop loss above here. Maybe it's a little bit close, but yeah, your liquidation price. So let's do this. So basically here, this is your liquidation price where they will force close your trade, but you already have a stop loss above here. As long as it's not too close, because you can have some slippage and stuff, this trade is still valid. And so you could do much higher leverage, but the point is, the leverage will not impact how much money you lose or gain. The only way to make more money with 10x leverage is to actually do it, I guess, wrong. So, because if you did this 10 BTC at 13,000, margin 13K. So if you did a 10 BTC trade here, you're actually 10xing the gains, of course, but also 10xing the loss. So if you did 10x leverage to be able to do a much bigger trade, you are increasing your possible gains, but you are also increasing your possible losses. So if we go back here, and let's actually change this one to contracts. So we are calculating the contracts instead, and we are using this as a base. So let's say then instead of buying 0.77 BTC, you actually bought 7.7 BTC. Click on buy. Now you're risking 10% of the account. That's way too much. I will also come back to explaining that. So you should do proper risk management. You will learn after a while that too high of a risk is bad long term. You can have some lucky trades, but this will come back and haunt you later if you do a too high risk. So the position size, so this position will basically be $130,000 buying 10 BTC. So the position size is the one telling you how much you will make or lose on trade. There. So basically on the 1 BTC trade here with a 10K account, you're losing $100 if this trade isn't working out. And if this 10 BTC trade isn't working out, you're losing 1K to count on one single trade. And just remember that it doesn't matter how good of a trader you are, all traders can have a losing streak, meaning that you can lose maybe as much as 10 times in a row, because markets are, of course, you can predict a lot of stuff, but markets are somewhat random also. One person could do something funky and sell too much, impact price action. You can get some news. Stuff can happen. So you can have a losing streak, and if you then are risking 10% of the account, you will, in the end, you will get wrecked pretty much. So do proper risk management. This works the same way to the short side. So same type of calculation. For a short, you're basically, let's say you want to short 1 BTC here. So depending on the exchange, let's say you're sitting in USD for the margin. So you're basically here, you're basically lending 1 BTC from exchange. Could be with leverage like this, so you could only have to put in so the 10x leverage, maybe $1,300. You will still have a liquidation price depending on the leverage. If the leverage is high, the liquidation price will be closer to entry. If the leverage is lower, it will be higher. Same type of setup, and the point with the short is that you are you did a loan of 1 BTC here. You want to buy it back lower. So let's say you buy it back here, which is a good trade. So since you did a loan of 1 BTC here and you bought it back $600 lower, you made this difference. Then you pay back the 1 BTC, not the funds, but the 1 BTC here. Now you don't own the exchange or anything, but you did make the difference here, because here it was a loan when BTC was at 13.6, and you bought it back here at 13K-ish. So yeah, you made this difference on the whole BTC. So that's leverage trading. It can be so most people getting wrecked doing leverage trading either are not using a stop loss and they are getting liquidated, or they do this error. So they're using the high leverage to be able to do a much bigger position than they should, because they are not using proper risk management. So they had, let's say they had a 13K account. At spot, they were able to do a 1 BTC order, but with leverage, they were able to do 10 BTC order. So now they are making so much more money if the trade is working out. But the thing is, those people will usually not buy at a good spot, and they will get licked, and they will lose all the margin, and they end up in the statistics. But yeah, so most people don't do this, so they will just end up in the stats about all the people losing all their money. Basically 90% plus of the traders are losing 90% of their account in 19 days. 90. That's quite true. It's very true from my experience. So use proper risk management. Long term, that's the only way.